Hey guys, we're going to continue with our analysis of the fundamentally sound stocks that at least held their ground this week or did not move down, and some even moved up a little. So we'll take a look at those. And one of them would be Value Line Incorporated. Now, Value Line is actually a publication. And they are a publication, they're a little pricey, but they're a publication that makes investment information. I'm giving you investment information about what the numbers say about these particular companies. I'm showing you PE ratios. I'm showing you how the company did overall in terms of their sales and their profits and so forth, their balance sheet. But Value Line gives you news about the company, what's going on inside of the company, things that could have affected their bottom line, which is how much money they made for that year. Things about store closures or new stores opening and things of that nature, how they're doing overseas. So that is what that is what they actually do, or what they provide, the service that they provide. Now let's take a look at the numbers. And often when we're looking at companies which we consider fundamentally sound, they can tend to be a bit pricey with their shares. The last one I just analyzed was around 200 right now, and that's falling to its low, its annual low price. But Value Line is at an affordable $38.58 a share. So let's take a closer look at this company. In terms of the earnings per share, and remember, this isn't just earnings, this is earnings divided by the complete number of outstanding shares that this company has. And I'm going to scroll down so we can see how many outstanding shares they have. This company has 9.43 million outstanding shares. So this may seem like a small number, but it's not. It's just divided by outstanding shares. 2018, it was $1.52 a share. 2019, $1.24. It dropped a little. 2020, it was up again $1.55. And bear in mind, that's COVID year. That's COVID lockdowns. 2021, it went up to 243, and 2022, it went up to $2.50. So their earnings is increasing almost every year. Currently, it's at $1.96 a share. But remember, we're in October of 23, so there's still 2 months to the end of the year. So there's still time for their earnings to increase for 2023. Now, let's look at what they made. In 2018, the low price for this stock was $15.49, or I'm gonna just round it off, $15, and it went up to $24. In 2019, it went from $15 to $27. In 2020, it went from $20 to $32. In 2021, it jumped up a little from $25 to $46. And in 2022, from $41 to $98. And now the low price has dropped a little. We're at $38.50 a share currently. So let's look at our PEs. And PE is short for price to earnings ratio. The PE, the low PE for 2018 was 10.19. In 2019, it was 12.86. 2020, it was 13.25. 2021, it was 10.39. And in 2022, it was higher. It was 16.54. So, the PE ratio, the reason we look at that PE ratio is because the PE ratio gives us an idea of how low this stock could drop or how high it can move up throughout the year. We see that the PE ratio is currently at 19.64. Is it going to stop here and then move back up, or is it going to drop even further? Well, let's see what happens. First, we'll look at how far it can drop. Then we'll look at how high it can go. So, let's say that the PE drops to 16.54. And let's say the earnings per share don't go any higher than where they are right now. 1.96. That means this stock can drop from $38.50 a share to $32.41 a share. But let's say the PE was to drop all the way to where it was in 2018, which was 10.19 times our earnings per share, 1.96. This stock could actually drop to $19.97 a share if the PE continued to drop and it went as low as 10.19, which it was at in 2018. But let's say it stays where it is at 19.64. And we're going to see how it's usually moved up over the years. This year it moved up 6, this year 10, this year 7, this year 9, and this year it moved up a bit. I'm not even going to count that. Let's just look at the bottom one, which was 6. Let's say it moved up from where it is, 19.64 times, or I'm sorry, let me do that again. 19.64 plus 6, that's 19. Let's just do 25.64. That's 1964 plus 6. That's 2564 times $1.96 brings us to $50.25 that this stock can move up to in the next 12 months. Now, let's jump over to Yahoo Finance and let's see what they say. The analysts the analysts at Yahoo Finance, they're not giving an estimate of where this stock will move up to. But from my analysis, based on PE, I see it moving up to $50.25 in the next 12 months. Now, we have to consider when you buy a stock, you can make money in two ways. One way is the stock can go up in value, right? And we just looked at how much this stock can move up in value this year, not speaking of the following years. The next thing we're not going to look at it directly next, but the other thing we have to look at, which we'll get to at the end of our analysis, is whether this stock pays a dividend for each share. So let's analyze this company further. We're going to jump down to the income statement. And now instead of earnings per share, we're seeing the full numbers. Value Line made $35 million in 2018, $36 million in 2019, $40 million in 2020, $40 million again in 2021, and $40 million again in 2022. And notice in 2021, 2020, 21, and 22, they only moved up moderately from 40,299,000 to 40,392,000 to 40,525,000. But they did move up each year. The net income, in other words, we saw the top number, we saw the sales that they made each year. But after they paid all of their expenses, what was the profit they made each year? Well, in 2018, from 35 million, after paying all expenses, they had 14 million in profits. In 2019, after making 36 million in sales, they had 12 million in profits. In 2020, after paying 40 million in sales, they had 14 million in profits. In 2021, after making 40 million again in sales, they had 23 million in profit, a bit more. And in 2022, after making 40 million in sales, they had 23 million in profits again, quite a bit. So let's look at their profit margins. We see the amount of profit they made, but when we compare the amount of profit when we compare the amount of money they made in sales for each of those years, and then we look at what they were able to keep in profit after paying all their expenses, what was it? In 2018, they kept 41% in profit. Very impressive. In 2019, it was 33%. 2020, it was 37%. And in 2021, it jumped up to an astounding 57% that they kept in profit. 2022, 58% that they kept in profit. So this is a company that manages their expenses very well. And when they make all of their money, they know how to keep a significant amount in profits. They don't spend much money to run their business. Having said that, let's look at the return on equity. Return on equity 33%, 25%, 27%. That's the return on the shareholders' money. Or if you're a shareholder, the return on your money. 33%, 25%, 27%, 34%, and 29%. This is quite impressive. And what's also impressive is the debt to equity. They keep their debt down 99%, 93%, 104%, 80%, 61%. We know that with the debt to equity, we like to keep it under 200%. But some companies really need debt to run. And if you analyze a bank, you'll notice that for a lot of these banks, the debts can be around 1,000%. Having said that, let's look at our balance sheet. Um, Sorry for the birds, they're not agreeing with me today. I'm working outside for you guys. When we speak of the debt to equity, let's look at the balance sheet. And the balance sheet is broken down into current assets, short term things they own, against current liabilities, short term debts or things they owe. And we see that with the balance sheet, their assets exceed their liabilities slightly for 2018, increased in 2019, increased more in 2020. Now, when we jump to 2021, not only do their assets exceed their liabilities, it's almost double their liabilities. And in 2022, their current assets exceed their current liabilities by more than double, by over a year. Let's look and see if it's the same for total assets and liabilities. In 2018, the total assets doubled the liabilities. Same thing in 2019. Almost double them in 2020. Exceed them by more than double in 2021. And exceeds them by more than one coming on too in 2022. What does that mean practically? That means that if this company was to go through another year like we had with, let's say, COVID lockdowns, a lot of businesses were locked down. Based on the balance sheet, That's telling us this company could survive. They have enough cash to survive about a year with no new money coming in, just from their balance sheet. They do pay a dividend. They paid $8 million out in dividends in 2018, $7 million in 2019, $7 million again in 2020, $8 million again in 2021, and $8 million again in 2022. And they bought back more shares of their own stock in the last 5 years, which we like to see. Now, companies can pay you a dividend, but the question is, can they really afford to pay you the dividend? Or are they borrowing money just to pay you a dividend? If they're paying you that dividend from the free cash flow that they have sitting around, that's a good thing, and that means that they will be able to continue to pay you a dividend. But if they don't have enough money to pay you a dividend and they're borrowing to pay you the dividend so that you'll keep buying or holding on to their stock, that means that dividend can stop. So let's look at first their free cash flow. On the net income statement, they made $14 million in 2018 and they had $6 million in free cash flow. They made $12 million in 2019 and had $11 million in free cash flow. They made $14 million in 2020 and had $5 million in free cash flow. They made $23 million in 2021 and had $16 million in free cash flow. And they made $23 million in 2022 and had $24 million in free cash flow. But in 2018, they didn't have enough free cash flow to pay the entire dividend they paid. Remember, they paid out $8 million in dividends, so they actually paid up all the free cash flow and had to use borrowed money to pay a little for that dividend. In 2019, they paid the dividend from their free cash flow and still had $4 million. But in 2020, they ran into a problem again. Did have enough free cash flow to pay the entire dividend, but they had $5 million to pay some of it. So they had to reach into borrowed money probably to pay $2.6 million. In 2021, they had $16 million in free cash flow. They paid the dividends and still had $8 million. And in 2022, they had $24 million in free cash flow. Paid the dividend and still had $16 million. So they're getting free cash flow. They have net income. Now, this company is a little bit of an anomaly. It's a strange bird. Because if we look at who holds most of the shares for this company, it's not held by people like you and me. It's not held largely by people like you and me, even though we can buy shares. And it's not held largely by investors, professional investors, banks, institutions, and so forth. Banks, institutions, and so forth, they just own 6.55% of this company. That's not a small amount when you consider there's 9.43 million shares, but it's a small amount percentage wise. But this company has 9.43 million outstanding shares, but they only have 792,000 that's available to the general public. So who's most of the people holding this stock? Insiders, people who work or involved with the company. They own 91.50% of the shares. To put that in proper perspective, generally when we analyze these companies, under 1% is owned by insiders. If we find a company that's maybe 5% is owned by insiders, that's impressive. But this company, 91.50% is owned by insiders. That means, I don't know if it's family owned and they're holding on to it or whatever, but what it shows me is that those who work for the company believe in it and they're holding on to it. And hey, I don't disagree with them. I feel, looking at the fundamentals, it's a solid company as well. I read Value Line. I used to use it regularly for my analysis. So I feel it's a solid company. Their dividend yield is 2.91%, meaning for every share you own currently, you get a 2.91% dividend annually. The last dividend they paid was 28 cents for a share. Howard A. Brecher is the chairman, CEO, president, and chief legal officer of Value Line. He has been with the company for more than 20 years and appointed to those positions in October of 2011. And even though S&P Global Inc. and CMA Group Inc. are at the top of the financial data and stock exchanges industry, Value Line is in this sector as well. Okay, now that we've looked at our fundamental analysis on Value Line, let's look at some technicals. Let's look at our candlestick chart and see some of the price movements for this stock. We see that it moved up regularly. It was moving up here until we got to April, the week of April, early in April, April 11th of 2022. Then, in the week ending April 18th and 22, it dropped significantly. Moved sideways a little, moved up, moved up. This was its high point. It was above 112. And then, in the last week of August of 22, it dropped significantly. You see a positive candle, then another 2-week drop, 3-week drop. Now we see it going sideways for a while. It's dropping a little more. And we see for the last 2 weeks, it's been moving up. So if it continues to move up on Monday, that could be an opportunity. But just bear in mind, the market's been going down the last 2 weeks, and there's no guarantee that it won't continue to drop. So if it starts to move up Monday and you jump in, and then it starts to reverse on you, you don't want to lose money. You want to get out of it. It can drop further, and if it drops further and the P goes down further, and we see it's an opportunity to jump in, you can do so. But here we see 2 weeks it moves up, it drops. 2 weeks it moves up, it drops, a down week. Here, 2 weeks up, it drops. 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 Two. This is one positive week. Then the next positive week, a big move up, but it's easily over 112. But it drops back to 101 by the end of the week, and then it drops from 101 all the way down to 68 by the end of that week. Moves up a little the next week, and drops for 3 more weeks. So we've seen a pattern of this stock moving up a couple of weeks and dropping again. If it starts to move up Monday and you jump in, and then it reverses in the following days, save your money and get out. Now, having said that, let's go to a 12-month chart for this stock. And we see, well, actually, they went down for a few years from 2007, 2008, 9, 10, 11, 12. Then they started to move up. And over here in 22, we see they moved up significantly. All the way up. Can't see the number up here, but definitely this is above 110. They moved over 100, above $110 a share, but came back down before the year ended to around $51. And now we get into this year. They tried to move back up a little, but it came back down. And here we are at around $38 right now. That's where the stock is at now, $38.50. So if we look at Value Line fundamentally, we definitely see potential in this stock. They're giving a dividend. It's not a great one, but they're giving a dividend. We definitely see that the fundamentals are there and that the owners who own a large percent of the available shares believe in this company. Just an opportunity to consider to add to our portfolio.